Welcome to the Hanken Cash Club. I hope your day started with money. Today we're taking a look at LifeMD, a telehealth business just now turning profitable, growing at 30% and trading at just over 1x sales. Best part is huge discounts Black Friday on the stock exchange. The stock dropped a lot on earnings due to guidance being cut, and now it's trading at 1.2x sales. So what's HIMS trading at? Well, right now, forward price to sales is around 4.5, with the trailing 12 months at 5.8, and it's been about there for the better part of this year. And LifeMD, well, 1.2, and the trailing is around 1.5. If HIMS is a 10x or a 100 bagger over the long term, then there's a load of money to be made with LifeMD too. So why did the stock drop? Well, first a quick introduction to the business. Like HIMS, they're also a telehealth company, but unlike HIMS, they are more focused on providing online doctors visits and combining that with their own pharmacies and integrating subscriptions into their business model. This way, they can treat some more serious conditions than if a customer were to self-diagnose and just order some pills. And what about their growth profile? Historically, pretty darn great. Their business is divided into the telehealth business, which we just talked about, and WorkSimpli, a PDF signature software business that's unrelated to the healthcare part. While not growing a lot, WorkSimpli is now providing decent cash for growing the telehealth business. So in total, they've been growing around 20 or 30% yearly. The profitability is improving now with the telehealth business as well due to patient retention. Kind of like HIMS a few years back, they spent a huge amount of advertising to get the customers through the door, but once they are in, you can cut ad spend a lot and the customers can still keep being in your platform and keep generating revenue. So currently the company could be massively profitable if they chose to cut ad spend, but instead they choose to keep growing and having the bottom line break even, which I think is the smart choice for the long term. And they sure do know how to make customers happy. You can look at these figures for yourself, but I think they're pretty impressive. A 4.9 average rating is something that to me means customers will be subscribing to their platform or at least be coming back when they experience a new issue that can be treated over the internet. But if they're so great, then why is the stock down 50%? Well, as mentioned, they did cut guidance quite a bit, especially for the third quarter. As you can see, growth has been looking really nice until now, where they expect to possibly decline for a second consecutive quarter for total revenue. For the full year, however, they're still projecting a record year with around 18% year-over-year growth. The previous guidance for the full year, however, was much higher at around 270 million, showing some weakness. The question is this weakness temporary or permanent? Why are they cutting guidance? Well, good thing you tuned into the Hanken Cash Club. Mostly, the revenue hit was from their subsidiary RexMD. You can pause here if you want to read more about it, what I asked from fiscal.ai. But basically, RexMD sells mostly ED medication. They sell branded and unbranded as subscriptions, and the business has been doing pretty well historically. But now, since this space is super competitive, the customer acquisition cost has risen a lot this quarter due to competitors doing aggressive marketing campaigns. Management at LifeMD says that this is now mostly under control, however, and there shouldn't be much material long-term damage to their growth profile. So let's hope that works out and according to management's plans. And just like HIMS, they're working with a huge TAM, which is constantly expanding due to them offering new services. They just launched their brand new mental health platform, which they said in a conference call was partly why their focus was off the RexMD struggles, which we just talked about. They're looking to test and scale that over the rest of the year to hopefully have it start contributing to revenue after that. And yeah, it makes sense. Imagine a customer comes to them with a weight problem. And the same customer might also need dermatology products or maybe help with insomnia. And then they can cross-sell these services over the same platform, which is also why marketing spend is so high right now, but it is also so important to get the customers into the platform to be able to cut ad spend later on. Another thing I appreciate about LifeMD is their offering for patients is great, but they also offer services for providers, partners, and for the industry. LifeMD is not just a healthcare company, but also a software company, kind of like Optum at United Health. And by the way, if you'd like to hear my 2 cents on that company, please leave a comment below and I'll be sure to get to it. But yeah, LifeMD has modern platforms for doctors that are way more capable and flexible than the traditional services doctors' offices currently are relying on. And I highly recommend to look up this guy, Alpha Wolf Trading, on YouTube and search for the interviews he did on the LifeMD CEO Justin Schreiber. He comes off as a confident leader, and the way he talks about his company really makes you trust the management's vision. They talked about how doctors are still using faxing machines while communicating with each other. Imagine that, like old technology that is still being relied upon, and it makes you also think about the sort of inefficiencies doctors and patients are experiencing that could be solved by LifeMD's current or future software solutions. Sorry, I got some drink in my throat. Alright, it's time again for the part where we check the valuation. Is it possible to make money on this stock? I think so. Using a normal cash flow based valuation spreadsheet that assumes the management's lower end of guidance for the full year revenue at 250 million, we can see that the upside is here with these estimates. So what I did was I put 15% for the next 2 years, that is not 2025, and then 10%, which really assumes a pretty big deceleration in growth. A free cash flow margin of 10%, which trailing 12 months was 7, and the last quarter was over 12, so I think that would be possible. If we take the same multiple, which I think is sort of low for a telehealth growing nice business, then we have a market cap of just above 680 million, which if we compare to today's market cap and count in 5% dilution, which is kind of what they're doing now, but if they do become more profitable, I think they will stop that. But if we assume they continue diluting, that would mean an upside of just a double at the time of February 2030, which would be 5 years from now. And that is also assuming that the free cash flow multiple is trailing, like it is in the comparison. So that's a pretty good CAGR of almost 17%, and a price for a double with these assumptions is under 7. But I did do this pretty conservatively, didn't I? If we do assume what they historically been doing and maybe drop it off a little bit, and then assume they can get a bit higher free cash flow multiple and margin, then I mean, you don't have to assume huge numbers for a huge upside. Like this is a 4x over a 4x by 2030, and you could be buying under $15 for this kind of upside. And these assumptions are actually what was priced in earlier this year when the stock was trading around $15, and now since then dropped 55%. But yeah, the market was super optimistic about them earlier, and now they're assuming numbers that are declining highly based on pretty much what happened now for 1 quarter and what management claims is mostly under control. So they're extrapolating current events into the future. But I think it might be hard to really value this company at assumed free cash flow margins and multiples when they really aren't that profitable yet. So I made a new spreadsheet here just below, and this one is based around sales multiples. So we take the same sort of declining growth numbers. There's of course still pretty good growth numbers, but lower than what they have historically been doing, and take the forward price to sales, obviously our market cap of 307 million. At February 2030, if we assume a 3 times price to sales, which is way lower than HIMS is right now, and I think would be more fair, then we get a market cap of 1.2 billion. And if we still assume the dilution of 5%, that would be 207% upside, or over a 3x. But even if we lower like the price to sales to 2, or I mean even 1.5, then you can see some decent upside. So, I mean, this company is a bit more risky than HIMS, obviously, in the sense that the company has not really proven its profitability and its growth seems to be a little more shaky than HIMS. But what you get in LifeMD is the valuation. This is kind of like HIMS was way back when HIMS was trading at maybe $7. Then they were at this point where they were kind of profitable, kind of not, growing a lot, and they had a huge ad spend, which at the time was the big problem for investors. Now you can sort of say it's the same thing for LifeMD. To me, it seems like an opportunity to catch up, but I wouldn't put a large percent of my portfolio in this, because it might be that they're swallowed up by competition, because HIMS really was the first mover and other players are also in the space. But if they can get a share of the pie and just grow a little bit and just get appreciated by Wall Street, then you can see what kinds of upsides they have. And just for reference, I pulled up this graph here from fiscal.ai, where they estimate, or the analysts estimate, the 2027 revenue of 350 million, which is lower by 20 million than what my model assumes. So analysts are expecting higher, but I try to always see what is sort of expected into the price. So that's why I wanted to keep it like this. But yeah, thank you for watching again, and stay cashing.